and welcome to this free training on property investing, primarily in the UK but relevant worldwide. So let's get started. On the first slide, training is an introduction to property investing. We're going to cover some topics such as an introduction to property investing, the different types of property investing, funding options, buying and identifying opportunities, briefly touch on company structure, buying, holding or flipping, different strategies, property for wealth creating, and starting with zero capital. Well, let's start with who am I? So I'm a former director and a shareholder of a gambling company. I still operate in that sphere, but not as much as I used to do. I started in that career many years ago, still licensed and still operating, but went full time into property about 4 years ago. During my time in the gambling industry, I project managed some large construction projects, but they were more along the lines of managing people rather than managing the actual um, ins and outs and smaller aspects, refurbs, that type of thing. But I did become a landlord at the age of 22, what you might call initially an accidental landlord. So I bought my own property and let a room out to a work colleague of mine. And then subsequently, when I moved abroad, I put that property with a managing agent and kept that property just as an investment property really while I worked abroad. Moved back into it briefly, and then because I hadn't received any sort of formal training, I sold that property in a few years later and bought a business with the money. And interestingly, what happened there was the business I built up, worked hard on, spent 3 or 4 years building that business up. I sold it. I made about £90,000 profit, and in that same time, the house appreciated for roughly the same amount of money. It was just at the bottom of a dip, and it rose over the coming years in the postcode that it was in. And yeah, first lesson in the power of property. It made exactly the same money in the same time that I'd worked hard in my business, and that was a lesson learned. So, but recently I went into property full time in 2018. I decided, due to various reasons, that I needed to diversify my income stream from the gambling business that I had, and having dipped my toe in the property market previously, as mentioned, I decided to look at it again and see whether I could make a serious business out of it. So I took some webinars like this and got involved in the education side of it. Um, you know, bought a couple of books, paid for a couple of courses, and identified what I thought would be something that suited my skill set. And I bought my first investment property in late 2018, which was a commercial conversion. So it was a mixed use block with a shop on the ground floor and uppers, which were made of a maisonette or formed of a maisonette. So over the coming months, I set about applying for planning permission to convert that into two flats above, and got the planning permission passed, converted that into 3 units, so two flats, a 2 bedroom and 1 bedroom, and the existing shop on the ground floor. And from then on, I'll show you, we applied for planning permission on the back garden there, which was passed for a 3 bedroom detached house. I'm going to show you some details of that project later. And also, we got planning permission for 2 bedsits at the back of there as well on an existing old workshop. So all in all, the initial investment property that I bought has turned into quite a lucrative income stream. I always hold my properties, I don't sell, which we can touch on later as well. And that now is generating a significant rent roll, fully tenanted, always has been, never any voids, with the bonus of the new build on the back, which we're probably going to sell for around about £280,000, and then 2 more rent streams coming from there as well. So all in all, quite an interesting property. And where the money came from that, I'll share that later on. But that was the initial deposit is the one that I've recycled and used again on the next properties. So over the last few years, I've created a 6-figure rent roll from my various different properties now, and a 7-figure portfolio, which would be valued at disposal of somewhere over 2 million in that region, and growing all the time with good capital growth on there. So I'm the sole director and shareholder of 3 property companies, one a joint owner of with one of my brothers, who's also a landlord and small scale developer. And I'm currently active in the market. So we've just finished one multi-unit freehold block of flats, full refurb, cash purchase, what's called a bridge to term product, and full refurbishment back to brick, and then that's now fully let. Gone on to a fixed rate mortgage. Again, I can share the figures, but there'll be more details on those sorts of things later on. And that's now fully tenanted. So let's move on. So what I mainly do and what suits my style or my skill set and what I'm comfortable doing is I buy what's termed BMV or below market value. That's done in various different ways by auction. I've bought at auction before, identifying tied properties, going direct to landlords, or tired landlords, various different ways to find properties, but always looking for below market value, so unmortgageable, things that people are scared of really, and that's the type of properties I identify. And then I undertake a full program of work, so that can be a strip out, anything in depth as new roof, new supplies, back to brick, refurbishments, damp work, fully refurbished to a good rental standard, and that creates a nice home for the local housing market. We don't do any holiday lettings. We have done in the past, but now we're focusing on creating homes for local employees, and mainly in a tourist area where I am. And those homes are in high demand because there's a lot of holiday lets around us now. Generally, we get around 30 applicants per property when we list them on the online portals. We don't use agents to manage the properties. It's self-managed. We use various bits of software and automation, and again, we'll share more details of that later. So multi-unit freehold blocks is the abbreviation there, which is basically a freehold property with multiple rental units in there, and that's the abbreviation there refers to that. And they're my preferred method. Reason being, it gives different exit strategies, so they can be selling individual units or refinancing the whole block. The other thing I like about MFUBs is that if there's one void or even 2 voids, depending on the size of the property, it's almost always covering the debt payment. And my strategy is to buy, refurbish and refinance back out to recover some of my or all of my initial investment. And then the debt is fixed on a 5-year term, and then the rent payments will cover that, hopefully. And if they don't, we look at the capital growth of the property, and the general rule of thumb is the more cash flow, the less capital growth, and the less cash flow, the more capital growth. Extreme examples would be a London house on a standard buy-to-let, vanilla buy-to-let, would obviously offer a lower yield but a higher capital growth over time. And the other end of that scale is a house of multiple occupation where rooms are rented individually in maybe not as prime an area, whereas the cash flow is good, and the difference between the incoming rent and the debt, that the time management is higher and the capital growth is less. So a quick overview of what I do. I also look at planning gain. Can I add value anywhere by adding more units or new build in the back garden like we've done? And that leads on to new build. So new build properties, which you can see a picture there on the slide. The middle one there is now at the roof's on. So that's finished in the next probably 12 weeks. And that was a planning gain on an existing property. So primarily what I focus on is creating a home. I was a tenant for many years, in fact quite recently, and I now look at it from a tenant's perspective. I'm sure you hear many landlords saying that, but genuinely, as I was a long-term tenant, I try and create a home where people are going to stay a long time. And obviously there's a business sense to that as well, because you haven't got voids and changeovers. But on a moral level, you're providing a long-term secure home for somebody. And my strategy to buy and hold means that I can give tenants comfort that they can create a home and be there for a long time, and probably preempting some of the things that are coming in the renters reform bill. Allowing pets. We've always allowed pets. We've always allowed families and encouraged families. We always create a long-term secure property that's refurbished to a good standard, and our EPCs on the latest development were a C already. We put brand new heating in there, insulation, as much as we can. And then we've got at the bottom there fast and slow pounds, which is something I like to look at property. In the market, fast pounds could be HMO, which gives you quick, higher returns, and slow pounds could be the example I used of long-term capital growth. And controversially, you may think you could look at the rent in effect as an addition or a bonus. And if you look at just the capital growth of property historically over time, you could argue that the real wealth in property is created in never selling. It's buying right and never selling. It's not in the ongoing cash flow, and that compounds over time. And my remit is to create generational wealth, not a high income as such. Flipping property for me is a job, and although I do that, it's not my primary focus. And the thing with flipping is there's tax implications, and it becomes a job, and that suits some people. But for my strategy, I put more emphasis on creating time rather than high amounts of monthly cash flow, and the freedom that the hands-off approach to long-term letting gives me. Yes, it's less monthly returns, and if I turned every property into an Airbnb, for example, I'd get much higher income but less time, and that is my focus, and it gives me more time to spend on my yacht abroad, which I enjoy with my young family. My lads are 12 and 11. I'm always around for them. They come with me everywhere as well, and it's powerful. The financial freedom that property can create is different to the one I had before, where I earned a lot of money, but I didn't have a lot of time. I had a high-paying job, but they got their pound of flesh out of me. And this is one of the reasons I went heavily into property. So let's move on to the next slide. Property market capital growth. Just some headline figures here. We hear a lot of negative press about, there's going to be a property crash, and particularly the Financial Times and the Telegraph. I mean, I could screenshot some of the news that gets fed to me daily, and on the same day there can be opposing articles on the property market's booked, predictions and grown, or the property market's book predictions and sunk, and you've got to just cut the noise out and stand guard at the door of your mind, really, to be a successful property investor. And it's more about time in the market than time in the market. So if you take a long-term view on it, um, be honest with your calculations, accept that there may be periods of feast and famine in terms of interest rates and things like that, but hold firm and look at long-term capital growth as well as income. And you can see from these figures, which are the Savills figures, that property prices are predicted to rise by 21% over the next few years. And not only that, if we go to the next slide, the market demand is phenomenal, and I can vouch for that firsthand. Whenever we put a property on, market rents are increased from the previous time we advertised it, and the demand is still there. The only issue now is affordability, but we're finding that there's plenty of working people or people on, PIP and things like that that are happy to look at good refurbished properties for long-term letting that allow pets and families, and pay a little bit of a premium for that. And that's what we try and create. And we often get 40 applicants within the space of a few hours when we put a property on. And that's anecdotal, but if you look at the stats as well, these are headline sort of stats that I took from doing a little bit of research. Demand is outstripping supply, competition leading to some tenants offering well over market rate. Well, what we've tend to found is not offering over market rate, or we have had that, but we don't really go down that route. What we do is we take people who are willing to pay more rent up front, and that obviously mitigates our risk, and it pushes them to the front. And we're finding we are getting tenants who've got savings, who are looking, for a good home, and they're willing to pay 3, 6, months rent up front. So yeah, good news for landlords is that rental prices across the UK continue to rise. The demand for tenants is offset by the lack of properties available, meaning rents are set to rise by another 5% in 2023, following on from an already substantial rise of 9.7% in 2022. High demand for rental properties is set to continue in 2023. The cost of living squeeze and higher mortgage rates are likely to delay some aspiring homeowners from buying their first home. The end of Help to Buy in March is also expected to lead to some renters staying in the rental market longer. Our own experience backs this up, as I've just said. And the demand's there. I honestly think if we were to put 100 units on the market, we'd have them let within a week, or possibly two. In our area. And from what I've gathered in other places and on the forums that I participate in, it's the same everywhere else. So yeah, if you create the homes and you do them right, and you create good, modern, insulated, economical homes, then the demand is going to be there. And a little bit about why I hold. There's a picture there of an auction property that I bought, which was well, it's still a pub on that picture there. And that property already had planning permission, but for a holiday let on the ground floor. I resubmitted the planning there, and I created a 1-bed and a 2-bed ground floor flat that are very nice. They're in an area of town that attracts local workers. That was a £95,000 purchase price. It already had 2 existing rental units on the top floor and the middle floor, and that now cash flows at around £25,000 a month, with a net debt payment fixed for 5 years of just over £500. Yeah, I mean, there was a lot of work involved. That was a full planning application, a full building regs conversion, commercial conversion, which was a lot of sound testing, air testing, all those types of things, but a process nevertheless to follow. And yeah, so the strategy with that is to hold. It was refinanced. Most of the money came back out on that project, and it's now cash flowing with 4 tenants, paying an average of around 590 a month, I think. There's a 3 double bedroom in there which is coming on again at and that was initially was 590, and now that's going on at 695 with as it stands 37 applicants for that, and that shows you the increase in market rents. That's in a period of 2 years. So the reason I hold property is that one there. You can refinance it. You don't need to sell. You make money when you refinance, and the advantage of that is that it's debt. So you're refinancing out debt that goes into your account as debt. So there's no capital gains or corporation tax or personal tax to pay on that. That's a lump sum that goes into your bank, and yeah, you can do what you want with that. If I was to sell that property, I would have a capital gains or a corporation tax implication depending on whether it was in a company structure or not. So yeah, capital growth over time, and the debt reduces. If you look at inflation now, debts are going down in relative terms, and the value of money is going down. So if you put your money into a capital appreciating property, and it has debt on there or a mortgage that's depreciating over time. So as the capital increases or the capital value of the property increases, the debt reduces, and that's why inflation can actually be good for landlords, because it increases rents and it reduces the real terms of debt. So getting on the other side of inflation with property investing is quite a lucrative thing. So yeah, I mean, property holding, it can be hands off. You can bring in agents to take away a lot of the pressure from you and compliance. The other thing there is, of course, leverage of debt. So if I was to have £100,000 and I bought £100,000 worth of shares, I would benefit from £100,000 of the gain over time. And the difference with property is if I put that £100,000 down as a deposit and borrowed £500,000, I would benefit, and I'm leveraging £400,000 of the debt's money, but I get 100% of the uplift. And that's something that was explained to me early on, and is incredibly powerful. So I'm benefiting from a £500,000 capital growth increase with £100,000, and that's leverage. And that again is powerful. Property is scalable. Once you've got in a bit of momentum going, you've got rents coming in, and you've refinanced and got initial investment back, you can go again. And it's scalable quicker if you bring in JV finance, which I don't, incidentally. It's all financed personally. But if you want to grow quicker, then you can bring in joint venture finance, private finance, and you can go a lot quicker, and it can be scalable quickly, as I found. As I touched on there, it reduces the inflationary effect of cash in the bank. So if you're sat on £100,000 at 10% depreciation, the following year it has the buying power of 10% less. At the moment you might get 4% in the bank on savings, so it's not as bad as it used to be, possibly. But if you look at the numbers I'm getting in return for my money, it's way. In fact, it's infinite on cash invested if I can refinance out, and much more often. If I couldn't do that, it'd be 30-40%. So it still makes sense for me. I'm not going to get that return in a bank with my cash. Property is relatively difficult to take away. There's a lot of talk at the minute about a universal digital currency, and some conspiracy theories towards that. What I like about property is, yes, it can be taken off you, but it's a lot more difficult. I can wake up tomorrow and have half my balance taken away from my bank account, and people say, well, that's not going to happen. Well, the people in Cyprus probably thought that as well, and it did. And I've got first-hand evidence of that, where one of my parents' friends was actually looking at their online banking in Cyprus, and half of it disappeared, and that was the government, and for whatever reasons they use for that, debt crisis, war, you can take your pick, but it's a lot harder to do that with property. And I always maintain, if you're doing the right thing, so if you're thinking of it from a moral aspect, you are providing homes, you're not being a greedy, slumlord, then things should follow on from that, and things should be okay. Yeah, and that leads on to creating a wealth legacy. The creation of generational wealth becomes easier with property. I can hand this down now to my family. If I was to stop tomorrow and touch wood, I hope it doesn't happen. But if I came, incapacitated in any way, the income continues. The management would need to be taken over, but that could be handled by an agency, and those rents would continue to come in within reason. And that's not going to happen with a high-paying job. If you're a dentist, for example, and you stop working tomorrow, you could insure against it, yes, but would you be able to create the wealth that you're creating when you're there every day? Another reason property's powerful. There's lots of different strategies. So depending on whether you're cash rich, time poor, or you're time rich and you've got less money to invest, there's a strategy that matches your skill set and your requirements and your position where you are now. Maybe vanilla buy to lets might suit somebody who's cash rich and time poor, doctor, dentist, pilot, things like that. Or somebody with more time, rent to rent's a great strategy to begin with. It creates cash flow. Not something I look at doing, but that's where you rent a house and sublet it in effect as an Airbnb or something along those lines. And that can be started with very little cash. And then there's always the option to borrow money from friends and family or do joint ventures. So lots and lots of different strategies for every walk of life. So the next one can replace income and can replace pensions that are self-explanatory. And primarily the last one, it helps families and it helps create homes for people. Something that the press don't like to touch on. Landlords are portrayed as terrible, but at the end of the day, we're filling a gap that's been woefully lacking in successive governments. They haven't created homes for people, and that's left to the PRS sector, the private rental sector, which is what I am and what you could be too. So moving on, types of property investing. We'll go through these quite quickly. So vanilla buy-to-lets is a term that's used to describe a standard single family home, as they're called in the US. So just one house with one family rented out for one rent, and usually higher capital growth because it's an individual unit. Not always. Can offer great returns. In some areas in the northeast, you might be picking up a property for around about 35, 40,000 pound, getting 550 a month rent. And another extreme might be in London where you might pay millions for a house and not even covering the mortgage payment on it. But still, it has its place, and a lot of people like vanilla buy to let if they're cash rich, time poor, or just want to be a little bit more hands off. And it's a good long term strategy. It creates wealth over time with high capital growth. Commercial property, which is anything from warehousing to shops, a huge sector, something that I'm involved in and looking more at. It has its different nuances and can be more difficult, and you need a lot more experience in it. But again, something that you could, if you're leasing already, you might know a little bit more about it, which I was. I was already a tenant in one of my businesses, so I knew quite a lot about leases, so it didn't phase me. HMOs, which are houses of multiple occupation, shared houses, another great strategy, but a bit more hands-on, more difficult to manage, but great returns. And that's a strategy that some people purely focus on. And now coming into play are the higher end HMOs, or what can often be termed as multi-lets, or so aimed at a higher rental market with a higher quality finish. Multi-unit freehold blocks, which is what I do mainly, which is blocks of flats on one freehold title, and there's a lot of options with those: splitting titles, financing individual units, selling individual units. So R2R is rent to rent, where again I touched on, which is renting a property and then subletting it out for an Airbnb or a HMO. Flipping, which is buying, adding value and selling, or buying, holding and selling. Something that I do a little bit of just to increase the war chesting effect. BRR, which is buy, refurbish, refinance. Again, I mix that with the multi-unit freehold block strategy. New builds, again, something that I'm doing. Not for everybody and quite a lot more difficult, but for some people, they may find that a good strategy for them. Planning gain, again, that can be quite simple, and it can be done in your own on your own land existing? Do you have a big garden? Do you have some land that maybe has space at the side? To give you an example, we created the 3-bedroom detached house on garden that doesn't have any vehicular access. And there's other strategies that can be hybrid as well. But as I said, there's something for you in those strategies and lots to think about. Types of finance. Many ways to finance property and many different strategies. Cash, obvious one. If you've got cash in the bank doing nothing, you might want to look at getting a return. Or if you've got cash on the bank and you're scared of the implications of digital currencies or universal digital currencies or bank runs, things like that, inflation, that may be something you want to look at, getting that cash out there and into property. Standard buy-to-let mortgages, we all know what those are. 25% deposit, put a tenant in there, 125, 130% stress test on rent over mortgage, and usually a capital growth long-term strategy, unless you want 40 or 50 of them, which some people do. Bridging loans, which I look at exactly the same as cash, but just a little bit more expensive. I use bridging quite a lot, and I often do a bridge to term product. And the advantage for me of using bridging is somebody else has realised the value in a property. So I've got to get the property valued, and then it has to offer adequate security to the lender. And in that respect, I know what the property is worth, and I'll often get a post valuation. So I'll get a bridge to term product where I'll buy with a bridging loan. Yes, the fees are quite high, but I look at that as opportunity cost. And then I might get that post valued, assuming I do the works that I've set out in my work schedule. So I already know the valuation when I finish the works, and that helps me with my going in numbers, and it helps me to negotiate on the purchase price as well, which can often be unrealistic. Often you'll find agents value properties as if they were already refurbed, and I can go in there with strong numbers based on my comparables and put good offers in that I know are going to work. So that's what we call bridging and bridge to term products. Development finance can be borrowed. I actually don't use dev finance. I use my own money to do the refurbs, but it can be borrowed in arrears. So you can put, say, 30 grand up, and then that can get assessed by a QS, or the bank's QS will come down and they'll value that works up to that point, and then they'll pay in arrears. So a good way if you're doing bigger projects. JV, which is joint venture finance, that can anybody they often say the target finds the arrow. So you might get the project first, and then the funding might find that project if it's the right project. I often recommend putting the deals together first, and the money will come to the deal if it's the right deal. But at the same token, you don't want to be giving yourself a bad reputation with agents if you can't complete on deals. So it's good to be somewhere along the line with your investing, but also at the same time, the money will find the deals. And in that respect, private finance, there's lots of people with money in the bank who are just looking to get it out of the bank. You may be one of them, and you probably know quite a lot of people who have money in the bank who are looking to do that. And if you can offer them security and a little bit of confidence, they will lend you that money. It's not something I've done because I just prefer to be in control. It's just the way I am. I'm quite an autonomous person. That's something that can be done. An option agreements, which is taking control of the property for a given period of time for a nominal fee, often in order to maybe increase value by planning gain or various other options. Yeah, so that's the different types of financing. And let's touch now on the offer that I've got for you coming up, guys. We've gone over and skirted over some of the advantages and disadvantages and different types of property investing. So I'm going to go through a couple of the things that I've got covered in a course that I've produced, and this course is based on my own properties, my own experience, me going from zero to around about 2.5 million valuation with a six-figure rent roll in just over 4 years. You can see exactly how I did it. You'll get access to me as well. Every week I'll do a live visit to one of my properties, and that can be an ongoing project, a new build, a refurbishment, or just looking around a property when we're doing maintenance and talking through some of the numbers. I'll show you how we evaluate different properties as well. I'll look at, you can follow me around and see what I'm looking at and how I'm stacking the figures up on that. I wanted to help people. I get a lot of people asking me questions all the time. I'll go on site and a plumber or, a builder might ask me, how I got into property, how I'm financing things, my refurbishment numbers, where I find the properties, how I finance them. And rather than going through it every time and going through these things, I thought I'd produce a course. And it's, I paid for training when I started. I found it incredibly valuable, and I think it's something you should invest in, is your own training. And I've got a lot to offer. I've got a lot of experience. I'm not driving around in Lamborghinis, and it's not smoke and mirrors. You can see my actual projects. You can look at my exact numbers, and it's all out there in the open. And I've put together this course. It's a presentation, video presentation mixed with text, and it's actually using my existing projects as case studies, so you can look at exactly how I did it, and you can follow my steps and you can do it too. And I started with a very, very low amount of seed capital. Yes, I'm in the north, but I think it would be shocking for most people to realize what they could achieve in the space of time I have with the amount of money I did that with. And in the training, I'll go into those exact numbers. I'll show you where I got that money from. And it's the sort of money that pretty much anybody with a house and a job can get the hands on. We're not talking about huge amounts of money here. I'll show you how I did that and what led me to that and how that progressed to where I am today. So there's going to be a particular emphasis in my training course on buying below market value, where to find those properties, how I find those properties, how to value those properties, and how to post refurb value those properties, what calculations my valuers use, what multiples they use, and how to work that back to your buying costs. So not working forward, working backwards from the end value to work out how you can get all your money out and recycle your initial deposit and refurb money, and what figure to buy at to achieve that, which is very, very important. Now, it's a 14-day training course. There's one module a day, and at the end of that, there's an exam, and you'll be given a certificate as well. So every day you can sit down, block some time off, and I'll present to you all the different strategies and the different ways you can get involved in property. We're going to use real life case studies using my own projects and numbers. Everything's out there for you to see inside this training. There's a structured online learning portal with all reference materials, and you'll get unlimited access to that. And I'm adding to that all the time. So when new case studies come up or relevant information, it's going to be added on, and you'll get access to that all the time. You're going to get access to me personally through my private group. We've got a community private group, which you'll be given access to, and you can pick my brains, ask me questions, some great valuable information in there. As I said, each week we're going to do a weekly live training, a day in the life. Follow me around, look at some of my properties, look at some of my projects, evaluate some of the deals that I'm looking at with me, give you some insights into how we do things. And another very, very important thing is mindset education and training. I went through a shift in mindset at the beginning of my journey. I stopped drinking, for example, alcohol. I focused a little bit more on fitness and education, and that's a big part of any journey to success. Property is a great vehicle for creating wealth, but mindset is equally important as well, as is education and training. I'm going to give you a list of the books that I read in the beginning, the training that I took, and where to find information for free. And leading on from that, you can use my spreadsheets. I'll give you access to those. My deal evaluation spreadsheets in Excel, software that I use to manage my properties, things that I use on Rightmove, where I find my properties, and also contacts for people that I use for various different things, brokers and things like that. There's going to be some excellent bonus content in there which touches on the mindset training and education and training. So all in all, a great starter course for you guys. Some fantastically valuable information in there, and access to me as well. To give you an idea, if you go on a 1-day taste of property course, which may be free, they're going to try and sell you a course which will cost somewhere in the region of £9,000, £10,000. And once you get into the higher levels of that training, so you go to what they might call VIP or inner circle, they're going to be wanting 20 odd thousand off you. So this value that you're paying for this course is astronomically good value. I'm covering stuff here that you might have to pay tens of thousands of pounds for. And not only that, I'm not just a trainer. I'm actually doing these things, and I'm creating wealth for myself and my family. I'm creating time, more importantly, and it's happening live now. It's not something that was done 10 years ago. It's relevant now. The numbers are relevant now. The rental figures are relevant now. So take a look, guys. Join the training, and I'm sure you're going to get fantastic value out of it. And I hope to see you on the other side. Thank you very much for watching this training.